the people that we have here today. We're going to start first with Brian, who's the co-founder, CEO of Ground Floor. I'm going to ask each of you to introduce yourselves and share about your company. I'm going to ask that you keep it relatively brief, your introduction. I want to get into crowdfunding and see how deep we can get into this conversation. We have real estate debt opportunities, artwork, we have farmland, and we have an investor, Nick Perkin of Perkin Industries, who started one of the first, what we believe is crowdfunding platforms out there in finance. So I'm going to ask each of you to introduce yourselves, discuss your strategies, how the investment performance works, and the teams that are responsible for delivering the success. So with that said, we're just going to go in order here. Brian, can you kick it off? Give it a little bit of background on yourself.
Sure. First of all, great to be with you, Michael. Thanks for having us as part of this. It's fun to be here with Nigel and Carter. They both have had a lot of success in this alternative investing market as well. We've been at it since 2013. We started the company not knowing that we were going to go into real estate debt. We were in search of the next great mass market investment product. And as we conducted that search, we were well aware. My co-founder worked on Title III of the Jobs Act. He helped effectuate that into law, Nick Bargava. He was an expert really in what was happening at the time to start liberalizing capital markets so that the other 96% of us can get access to private market offerings. But here's another thing that a lot of people in the audience, I think, will care about and will think is interesting. The other aspect that's not talked about as much is in the process of opening up these private market offerings to the other 95, 96% of us who aren't accredited investors, the SEC also provided greater disclosure and public market types of protections for accredited investors in these markets. So when we launched Ground Floor, we pretty quickly figured out that to build a mass market product, we had to build an investment product that people could understand, something tangible, right? We ended up opting for real estate because it's tangible, residential real estate because 2/3 of people in America are homeowners at any given time, so people have an understanding of the asset class. And we decided to create a debt product because unlike equity products, debt products have low volatility. You can really narrowly cluster returns around a debt product, and we thought that would be good for people's portfolios. Over the last 7 years, we've delivered an average return of 10.5%. That's net of a loss ratio that's well below 100 beeps. Usually it's about 60 basis points, 0.6%. And we've done that returning capital on these investments every 8 to 9 months on average. What's unique about us is that we're truly open to non-accredited investors and have been since 2015 when we were qualified by the SEC. We are not a fund. You're not investing in a REIT or a package of securities or of investments. You are picking and choosing. You get to do what hedge fund managers do. And because our minimum investment is $10, even if you have $1,000 to allocate to this asset class, you can have a portfolio of 100 loans in your portfolio. And that's very unique. That's how the big guys do it, with broad diversification within an asset class. Now the market is really waking up, right? This is the renaissance of the retail investor, right? And so now we see a lot of different alternatives kind of popping up for people to allocate into. And in an era where the public markets feel as rigged as ever, when the public market casino is starting to leave a bad taste in the mouth of retail investors who are waking up to Robinhood, we think alternatives have a really long runway to take off and popularize. So that's what we're doing. It's first lien residential real estate debt. Happy to talk about it in more detail, but I'm just excited to be here with these guys and you, Michael, because I do think this is a very interesting and auspicious time for the retail investor and what's available to them.
Thank you for that, Brian. So Carter, let's jump into Farmland next. If you don't mind giving a background to yourself and your firm.
Sure. Hey everyone, Carter Malloy, and again, thanks for having me and Nigel and Brian and the rest of us on here today. Quick background on myself. So I grew up in a farming family. Did undergrad in physics. Spent about a dozen years in investment management. Most recently as a partner at a $1 billion long-short equity investment firm. In the background, been buying and selling farmland with my dad and then on my own, and having great financial outcomes, but truly terrible investment experiences of getting through that process. I was living in San Francisco at the time. This is 3 or 4 years ago. Had a neighbor come to me and say, "Hey, I want to invest in some farmland with you." Went online, and there's this moment of, oh my gosh, I think probably similar to Brian and Nigel, where we recognize that here's this $3 trillion asset class in the United States alone, putting up low double-digit unlevered IRRs, right? So pretty incredible investment returns, and again, unlevered. So the volatility of those returns have been much lower. As all of us, look for our portfolio within our portfolios, we look for portfolio diversification. We think farmland plays a very important part in that, in its risk-adjusted returns or the Sharpe ratio, its non-correlation to other assets, its inflation protection it has provided. So we're really excited about the asset class and really excited to bring the asset class to the forefront online and allow. We are open to accredited investors, but certainly have both accredited investors, family offices, and institutions all participating on our platform, and just raised our Series A actually as a business. So really excited to continue bringing forth quality investments. I think for us, that's the big thing. That's the thing we focus on. The thing we invest the most heavily in is data science and geospatial analytics and farm people, right? We're here in Arkansas. Our team is made up of farmers to find great investments to put on our platform, ones that we are truly excited about. Maybe 1 in 100 that we look at, ultimately our team underwrites and puts on our platforms. That's the quick and dirty on AcreTrader. Happy to explore more in the Q&A here as we go forward, but want to make sure I'm respectful of time.
Thank you, Carter. Nigel, I'm going to ask you to do the same.
Yeah, thanks, Michael. Great to be here with Brian and Carter and others as well. So, yeah, I'm Nigel Glenda. I'm the CFO here at Masterworks. I started my career as an investment banker focused on financial services companies of all types, and especially finance companies in particular. My career took a turn into the art market when I became part of the team that started a de novo art lending company backed by the Carlyle Group called Athena Art Finance. It was during my time there that I got to know the founder here at Masterworks, which was a related project, but one that was really more focused on the equity investment potential of the art market. So after 4 years of growing Athena, and we sold that business to another company called Yield Street, I came on board here full-time as the CFO at Masterworks. So what is Masterworks? So we're really the largest and only investment platform that's dedicated to what we see as the most investable segment of the art market. A lot of people don't realize the art market is a vast market. It tends to be overlooked by the broader investment community. I mean, you really have a $1.7 trillion market in terms of assets that are held by collectors on a global basis. And that's really what we find so interesting about the market, is that global nature. You really only have about a third of the market that's in North America. There's a tremendous amount of data density in the market, because of that $1.7 trillion market, you have anywhere between 70 and 50 billion that's trading at public auction or privately every year. And at public auction, you get all that data, transaction data, that allows us to build indices to really understand how's the market been appreciating, and really construct a long-term investment thesis on the market. What we've seen is the post-war contemporary art market in particular has grown on an annual compounded basis over 13% over the last 25 years, and really does in a way that has very low correlation to other traditional assets. And I get into the macroeconomic reasons why that is, but art just doesn't tend to behave in the same way as other traditional assets. Now, in similar to what sort of Brian and Carter have mentioned, you've got this really interesting asset class that effectively has a participation among, call it a couple thousand collectors, but really no meaningful investor participation retail, institutional, or otherwise. And that was the huge opportunity we saw for Masterworks. So really the V1 of the business was, how can we create a very simple mechanism that allows investors to gain investment exposure and effectively participate in the broader investment thesis around the art market. So that's what we built in Masterworks.io. So we were the first really to take a multi-million-dollar painting public. We filed it through the Reg A process. The SEC had just never seen anything like this before. That process came to a head in 2019 when we launched our first painting, a $2 million Warhol. Fast forward, we've raised over 100 million in capital today, looking to do 2 or 3x this year, all from self-directed investors. And now the next step is a number of investors beyond the self-directed community, larger asset allocators who now are thinking about high inflation scenarios into their model, really re-examining what it means to be diversified into real assets and thinking about art as a part of that. We're a 50+ person team here in New York with backgrounds across fintech, financial services, the art market, and data analytics. So I'll pause there for time, but thanks for including me and happy to take a deeper dive.
No, thank you, Nigel. Last but not least, Nick Perkin, do you mind giving a brief introduction about yourself and some of the background as far as your experience in the space as both a founder as well as an investor?
Yeah, thanks, Mike. Run a company called Perkin Industries, creatively called Perkin Industries. We are a portfolio of companies that we've directly invested into. I don't know if you guys can see me, right? I'm on my phone here. The office is out of electricity, so I'm on a phone at home. But the Perkin Industries has direct investments in about 15 different portfolio companies spanning everything from healthcare, real estate, social media, traditional media, and many, many others. We buy about 2 or 3 companies a year, all with our own funds. And then as of late, have been launching SPVs, where we're the lead investor into larger investments. Most recently, we did one into a big esports business called Rivalry that's looking to go public in the summertime. And so we're all over the place. We have one thing in common with our companies, which is they all produce cash and are accretive to us. But other than that, from a diversity standpoint, highly diverse. I think in terms of background, what Mike's referring to is I was once a entrepreneur where I used to think of an idea and build and sell a company. We built a company called Massive, which we sold to Microsoft in 2006, which was the creator of the in-game video, in-game advertising industry, which was a big deal back then, pretty standard stuff now. But more relevant to this conversation, built a company called the Receivables Exchange, which was ultimately bought by the New York Stock Exchange in part, and then changed its name now to a name I can't remember because it was 4 or 5 years ago. But doing about, as I last heard when I checked in, about $8 to $10 billion of transaction revenue, transaction volume. To give you a sense, when we started, obviously, I think Michael actually did the very first trade on the platform, and that was about $100,000 15 years ago. But we built a platform that basically disintermediated the banks from providing receivables finance, and actually looked at the receivable as like a 0 coupon bond, which could then be broken up into elements where investors could buy anything from 1% to 100% of the auction, and then circled family offices and various investment groups around it to bid real time on those receivables. So that grew very, very quickly, turned to going from small and medium companies financing the receivables that way to now large corporate paper where it actually competes with commercial paper. So that was TRE, and I think probably the most relevant component to what you guys are all talking about here today. Although on the buy side, we do see all kinds of companies that are in every industry disintermediating and democratizing some component of an industry, and we think it's a larger trend overall, and actually is guiding some of our investment thesis. So that's our background.
Nick, thank you very much for sharing your background. Thank you to all the panelists for sharing their background. I want to get into asking each one of you why you care about the retail investor. Why do you want to make your investment available to the everyday person?
I guess I can go first. Look, I've been an investor since age 15 when my dad sent me to the library, because we didn't have the web then, to go figure out what mutual funds were. And I have always been interested in investing. What motivated me to build a product for the individual investor is, I think, for the most part, everybody acknowledges we have a wealth gap. Now, that's for a lot of reasons, right? We have a significant wealth gap between people who are investing in the market accurately. I think I heard a statistic that 45% of Americans don't have any investments to speak of. And I think part of the reason for that, the insidious reason for that, is that we all complain about how we're not getting our fair share of the pie. I actually think the problem is bigger than that. I think the problem is we're not even being served the same thing. The fact is, if you've been a family office, a hedge fund, and accredited investor, you've had access to a whole range of investments that on a risk-adjusted return basis give you more control, more liquidity, more certain returns over time, and higher yields than are available to anybody else. And the consequence is that individual investors are left paying high fees or taking inappropriate risk in their portfolio. If you're saving on a 2-3 year time horizon, you shouldn't have your market in the SPY. That's hard to say today, given what the SPY has done, but that's bad financial practice, right? You should have access. I think people should have access, equal access, to invest on a level playing field with equal opportunity with everybody else. And that's what I think we're trying to do at Ground Floor. I think that's what these guys are trying to do by opening up these markets. But what drives me is, I think all investors deserve equal opportunity. And that's why we went through the process. We took 18 months and $1 million to qualify our offering with the Securities and Exchange Commission. We were only the third issuer to ever do that in a payment dependent note type structure with the SEC after Lending Club or Prosper. We're still, out of all these real estate platforms that say that they're crowdfunding and whatever, they're all accredited investor platforms or they're REITs. We're really the only one that allows everybody with $10 to show up and invest on a level playing field in these private market securities. And, we sold, $300 million of these securities over the last 6-7 years. We have 80,000 investors on our platform. So this is no longer small numbers, no longer a joke. This is really happening. And I'm sure these guys are seeing the same thing. When we talk about the retail investor and we equate it with Robinhood, that's not investing, that's trading, right? That's not how the hedge funds and family offices are making their money over the long term with less risk and higher returns. So that's what's motivated me and my co-founder over the years. And now we're broadening the business and trying to expand it into that same model into new directions.
Sure. Nigel, Carter, you guys want to step in? And Nigel, you're on mute.
Nigel, you're on mute. I'll let you go there.
Party fell there. For us, the opportunity was actually even more fundamental than just the retail market, right? So the art market really had zero investor participation of any kind at all. I mean, the self-directed community, I think, turned out to provide real product market fit for Masterworks, especially at the early stages of the business. What we developed was a business that very much similar to Brian's, where each of our assets are single asset SPVs, where we've got a single painting in each one. And really what is so important about that is it's a pure play identified asset strategy. We're not selling a blank check. We're not selling a fund. We're not selling ourselves as a manager that nobody's heard of, right? These are paintings. We give all the data, people can make their own decisions, have the data, the same data that we're looking at, and build a portfolio accordingly. So this was a perfect opportunity for the self-directed retail community. And so that's why we built Masterworks.io. We've got over 100,000 as part of that community going forward. We're very much still dedicated to that market. We don't think at all we've saturated that market, and we continue to see tremendous growth month over month of retail and self-directed investors that come to us. But I'll say even among that self-directed community, it's all different types of investors. We have folks that are coming in at the $100,000, $1,000 range. We have folks that are doing multiple hundreds of thousands or deployed millions of dollars across multiple paintings. So it's really that self-directed aspect that's been so interesting to us from the retail community. And I think for us has provided that foundation that is going to allow us to expand across distribution channels going forward, which otherwise I think would have been very difficult for us to do as a first step.
Thank you, Nigel. Carter,
I think for us, we were, it was really demand generated, right? At the end of the day, we had people. There's tons of interest in investing in land, right? There's both an emotional appeal, but like a really fantastic raw portfolio strategy appeal to it as well as an asset class. And so for us, the why build the platform was really filling a need, filling a gap where investors wanted to get access. And for us, we, our investors they are accredited, right? So our typical investment is kind of in the 30,000 to 1 million type of range is what we usually deal with. And we've certainly got, institutions and family offices on the platform. And we have, to Nigel's point, some very differentiated sort of pure retail, albeit accredited retail investors. We found in our platform that in working with accredited investors, it allows us to be more attentive to the investors. So frankly, the unit economics to our business are better and allows us to afford better support so that and I know Masterworks, Nigel and Brian, Ground Floor certainly has, both of your guys' companies have great reputations as well, right? But I think the ability to make sure we're there to answer investors' questions that again, I know you guys do as well, is very important to us. And so that focus on larger investors where we can make sure to have a really concentrated effort in working with them has been and remains important to us.
All right, thank you. Nick Perkin, why did you start the receivables exchange? What was the reason behind that?
Well, when we were looking at it, actually what happened was, so we had the exit to from Massa to Microsoft, which was 300 times revenue exit, and so a group of us from that exit were looking for places to put cash, and yields were low at the time, nothing comparable to where we are today, but at the time they seemed low, and so people were looking for alpha in some form or another, and so we started looking at the fund-to-fund business in the receivable space. So we started calling up all these factoring groups and said, hey, if I gave you $1 million, if I gave you $10 million, what would be the risk-adjusted return, and so forth. And the yields were insane. It was like 35, 40% risk-adjusted. And we're like, wow, that's really interesting. We should be all over this space. We should dump cash into it. And then we kind of thought about it. So, I had, before Massive, I had worked at a company called Kestrel Technologies, which was doing fixed income trading platforms for every type of fixed income you can think of. And so I had a lot of familiarity with the tech that had gone into building those types of platforms, specifically around zeros. And I called the CTO, who to this day, I think the smartest CTO I've ever met, still work with him whenever I can. Graduated from Berkeley with a PhD in computer science at 19, kind of thing. And he built all the platforms for Kestrel. And I turned to him and I said, hey, Chris, look at these receivables. And they kind of look like zeros to me. I mean, they trade at a discount to face, they pay off at maturity, and a whole bunch of other characteristics. And he's like, yeah, they kind of are zeros. And I was like, well, isn't it good? These things are getting 30, 20, 25%, 30% risk adjusted returns. How long until someone goes and builds a marketplace? So this is 2006, right? A little bit earlier than a lot of the stuff that's going on now. But, it was only a matter of time, in my opinion, until, someone came in and said, well, 25% is still really good at 15%, still really good at 10%. So, so we actually pivoted and then said, let's go and build the platform that actually unifies this case accredited buyers to go and purchase portions or all of receivables that are coming out of businesses, and basically circumventing either the factors or the banks that were traditionally providing that. And interestingly enough, what we did, it never made the news in the way that I thought it should have. But one of the things we did was we basically created the credit default swap for receivable defaults. So I don't know if you remember this, Mike, but we wrapped an insurance layer around it and charged whatever bips for the insurance. And it had a 100% guarantee payment of principal back on defaulted receivables under whatever the conditions that it had to meet were. And so the rates really plummeted. I mean, where people were charging 3.5% for 30 days on a receivable at a discount, remember at 80%, so obviously the percentage is much higher. Now it was down to like 90 basis points, 80 basis points. In fact, it got so low when we put the insurance wrapper around it that that we started getting, I got a lawsuit from the Factoring Association of America saying that we were, which is actually the first association lawsuit against a company that anyone I worked with had heard of. Because we were dropping rates so low. In fact, I was even getting a couple of threats from various people around the industry saying that we were putting them out of business, which we were, because they were charging so high.
So Nick, you're bringing up an interesting point, right? And this is the point that I want to get into next with the panel. And guys, I apologize. I want to get the most out of you. So if you could keep your answers succinct so I can cover more territory, I think it's going to be better for the audience. With that said, from the investment side, why is what you're doing today in farmland and artwork and real estate debt, why is that a good investment opportunity for the people listening to our webcast?
Sure, I'll happily tag on this one first. And I know we're all anxious to talk about this one. Why is farmland a good investment to us? First to clarify, you make money two ways: appreciation plus the rent that the farmer pays you. So we are not in the farming business. We own we own the land underneath and receive rents from the farmer. So very simple structure. And over the last 30 years, that's produced 11 to 12% type annual compounded returns. So pretty unlevered, again, as I mentioned earlier when we first started out. So attractive investment returns over the long term. It's a get rich slowly scheme, right? We're not here out to make 2x or 10x money in a number of months. We are all about compounding over time and doing so in a low volatility manner. Beyond the very attractive risk-adjusted historical returns, or Sharpe ratio is most of the industry use to describe risk-adjusted returns. Beyond that, the asset has very little to no correlation with any other major assets, so it sort of acts on its own. From a portfolio diversification standpoint, that alone is very worthy of consideration. And then lastly is it has served historically as a hedge against inflation. Lots of folks buy gold to hedge against inflation. Farmland is like gold with yield, right? So it has shown as tight, if not a tighter, correlation to inflation. The only real index we can find that it does correlate to, and yet again, it still pays you an annual income that today is better than treasury yields you're going to get, and junk bond yields are starting to get close to where we are in farmland. So I think for us, the fascinating replacement inside of a portfolio really centers around bonds and gold, where we can make a very, very strong argument as to why farmland is a fascinating replacement for us.
Awesome. Thank you, Carter. Nigel, you want to jump in now?
Yeah, this is great. And it's kind of a segue into what are the macroeconomic pillars for the art market? I mean, what you see is the art market has a massive supply demand imbalance. Demand is really driven by purchasing power growth of the ultra high net worth, which has been on a secular upward trend for decades, and certainly has accelerated over the past 10 years, and even over the past 12 months for that matter. You have that huge wave of capital that's chasing an ever scarcer pool of assets. So you have artists who are deceased, by definition, have a fixed supply of material that's available on the market. And even living artists can only create work so quickly. So you have scarcity on the supply side. Overlay that with the fact it's a global asset. So your Picasso can be sold in New York, it can be sold in Hong Kong or London. And what that does is creates a market that has exceeded inflation over time, and certainly over a 25-year horizon has shown that 13+% compounded return. And as a result has done so with really that low correlation that's very, that's common to what both Brian and Carter are talking about. And that's, to me, that's really the key value proposition here. And you have a market that otherwise has just had a handful of ultra high net worth collectors involved. So, what we've seen in Masterworks is people who understand that investment thesis and then need some sort of mechanism to be able to invest in it. And that's what we're doing.
All right, thank you. Brian? Brian, you're muted.
There you go. Sorry, I had
No
some
problem.
background noise here that I had to get out of the picture. In our case, what's compelling and unique about the investment for the investor and why it's good for them, yes, it's low volatility. It has some of these other. I really like the way you guys described it. I think what I would add in our case is that our investments are very short term, which gives the investor a lot of liquidity. So to turn over your money every 8 to 9 months and to only have to allocate $10 to each self-directed individual investment that you make means that you can always sort of peel money off the platform. It turns out 80 to 90% of the capital is reinvested when it's paid back, but it's purpose built so that if you need your money on a shorter time horizon, it's there for you and you don't have to sacrifice the yield for it. Now, as for real estate, we can all argue sort of in the current world whether real estate's going up or down, or whether there's a supply shortage or not, or if rates go up, will values go down. The great thing about being a debt investor is you don't really have to care, because if the loan is well margined, you're protected by a lien on the property. Now, if you're an equity investor, you have to care, because if you have leverage on the upside, that's wonderful. If you have leverage on the downside, that can really hurt you. And we've had to foreclose in some situations on loans that weren't well margined. And that's bad for the equity investor, but it usually works out just fine on balance for the debt investor. Like I mentioned, the loss ratio on this stuff is 60 bips. It's pretty low. The other thing that I would say is with us, our investors are investing to improve and add value to something. So this is really kind of like a small business investment or like a value-added investment, because our entrepreneurs are renovating aging housing stock that's in hot demand in the best real estate markets all over the country, not the overpriced ones, but the ones where people are moving to and demographics are in your favor. And you're really making money on that value add, right? On a well-margined loan. So I think that's the pitch for the asset class or the type of investment that we're offering.
Awesome. So Nick, given your experience, and by the way, your mic is on mute, just so you know, given your experience with the receivables exchange and everything that you did to raise like venture capital money and then actually build the marketplace for receivables, what's one thing that you'd like to know from each of these guys today? Something that would basically help you to make an investment decision to either invest into their operating businesses or invest into a product that's on their platform.
Oh, that's an interesting question. Tough one.
I didn't say I was going to make this easy on you today.
Well, look, obviously, taking it first from the standpoint of each individual asset classes. I mean, it's all fascinating, right? I mean, it brings back just a ton of memories of building a receivable exchange, and I don't know how big the groups on here are right now. It sounds like they've got some pretty good momentum. And they're also operating in a world where democratization, disintermediation are kind of the norm. Not to say that's not hard what they're doing. It's definitely hard building a marketplace. But you're in a world where the wind is on your back, where people are willing to look at investments this way. And so I can't imagine that any of you are going to have difficulty raising capital for what you want to do, given where the world is going. Everything from digital art to digital currency to farmland to people buying real estate through multi-investor type platforms, crowdfunding, crowdsourcing type solutions. I mean, it's going to happen. I mean, there's absolutely no way you're putting this GE back in the bottle. I mean, it's not happening. I mean, the accredited investor is one component. Obviously, I think that maybe will change, some groups versus others. But I think I think something's going to have to happen to the definition of accredited investor, because too many people. Someone said earlier that people weren't being served the same pie, and I couldn't agree with that comment anymore. I mean, I think that if you look at the GameStop type situation, if you look at what's going on with Robinhood, if you look at what's going sort of the equity activism that's going on right now, it's all part of the same situation, which is a very small group of people, whether it was investment banks or banks or whatever it was, at one point held on to the vast majority of the interesting stuff. I used to say back in the 80s when I worked in equities in the 90s that, by the time I hear about a stock, they were like 15 layers above me that had more relevant information about that opportunity that I had. They're totally useless. Now what's happening is you've got ubiquity of information. So everyone's got access to their fingertips through the internet of whatever information they would like. And they've got very similar access to information, if not identical access to information, that the large institutions do. So that drives down the people who can play, whether it's accredited or whether it's non-accredited. And you're just going to have a constantly growing groundswell of people that want access to diversified asset pools, and it's going to happen. So I don't really have any questions to ask. All of these models, in my opinion, are going to work if properly executed. I find the individual asset classes interesting. I've looked at all of them at one point or another. I've certainly looked at farmland. I've certainly looked at art. And now that these platforms are evolving, I think people are going to have increasing allocations to them within their portfolio, just like back in the day, X percentage allocation to gold. Now today, X percentage allocation to crypto. But all these other things are going to be in the mix. And so the institutions are going to come in. Of course, the accredited investors all the way down to the non-accredited are going to start playing in this field. So the sky's kind of the limit. I really don't have any questions to ask them per se, Michael, because I think they're doing everything that, they're going to raise money. They're going to be bigger. There's going to be people interested in these asset classes. So there's really nothing I can ping them on other than to say that they're all in the right spot at the right time.
Okay, so that's actually a good segue into this next part. You went over your asset class that you're working in. You gave your case to why it's the best, how it compares to other potential investments. But let's get into diligence. What sets your companies apart, on selecting the right deals to put on your platform? And, what do you guys do that's different to safeguard the investor capital from bad actors?
Sure. I'll do it. So for our platform, I think it's important to start with we're only a 3-year-old business, right? So mind you, but since the start, we've had 0 vacancies, 0 defaults. So first is, again, when we think about the general safety of the asset class, we're out here like openly claiming we are doing something boring, right? This is, we're talking about investing in dirt. This is not sexy stuff. But from a pure return generation standpoint, it is very, very fascinating. For us, what really differentiates us, not just versus the market, maybe online, but the overall private equity landscape in farmland and the total landscape in farmland is information asymmetry, right? It is the most important thing you can identify when investing is looking for an information edge over your competitor. And Nick, I think, said it best of, in equities, and that was 20, 30 years ago. By the time you heard it, everybody else had heard it. Like that could not be more the case today. It's so true. In the world of farmland, we are in an absolutely antiquated industry, no underlying data infrastructure. So we as a company have built a very unique and differentiated database and data science and geospatial analytical tools built on top of that, so that we have what we believe strongly believe is the most differentiated and unique view on farmland values that there is, like period, full stop. And so for us, diligence unquestionably is the most important thing we do. We want to stick to that zero default, zero vacancy rate, and really surprise our investors to the upside, which we believe we're doing today. We paid out distributions in December. Every one of those distributions was ahead of expectations of where the investors were, what we're expecting to see from a cash flow standpoint. So again, for us, it all comes down to, did we do that underwriting effectively? Did our team do a great job? And that's what we judge ourselves on at the end of the day, every day, is quality of offering. That is all that matters if we want to build a sustainable long-term business and truly be the category king within farmland, which we do. And we are today, and we plan on remaining so over time.
All right, next, guys, who wants to take a stab at this? And
I'll go next.
deep. Go deep, Brian. Tell us how you do this the right way.
Sure. I mean, so we look at it. I'll go next because we look at it a little bit differently. We've been at it for 7 years. We view our role in two main attributes, right, for us as a platform, right? Number one, we need to screen out the fraud, right? In entrepreneurship, sometimes in real estate, right, there is fraud. There's mortgage fraud, there's title fraud, there's fraud, right? So we go deep on that to make sure that the valuations are right and true and accurate. The property is actually there. We send out physical inspectors, for example. So we do all of the basic diligence that you have to do to make sure that the fundamental security underlying the investment is actually there. Now, the other thing that we're doing as a platform is we are grading and rating risk, right? We don't view our role as to protect investors from all risk. We view our role as properly quantifying and disclosing the risk. So for us, we have a lot of investors who will only invest in grade A and grade B loans, because the way you get an A or a B is you put a lot of cash into the deal as the sponsor of the deal or the borrower, and you have a lot of experience, right? And your leverage is low, so it's a lower risk loan. It also has a lower yield, by the way, right? It's a 7 or 8% yield. But we're not here to tell investors what their strategy should be, right? There are other investors who only want to invest for very high yields and are willing to tolerate maybe defaults or delays in repayment or maybe a higher loss ratio. And they're shooting for that 12 to 14% yield. Now, on balance, they might actually only clear 11.5 or 12%, right? And on balance, their loans may take a little longer to pay back because those loans are maybe not as well margined. We may have to foreclose more frequently, which imposes costs. But our goal really is to, filter, grade, and rate, rate and grade and quantify that risk, and to make sure that the investors have the right disclosures and tools to sort of make their own risk trade-off decisions, right? We're not here to do that for people. And I think that's what's great about what all three of us are doing, because we're all allowing people to self-direct. And why shouldn't the individual investor retain their agency, right? If I told you that you could invest in the stock market, but you could only do it through SPY or a mutual fund, I mean, you look at me like I had two heads. You'd be like, no, I want to buy Tesla. I want to buy Google. I want to bet on this biotech. Why don't we allow everybody to do that in private market securities, right? We definitely should. And if you have the disclosure and the filtering in place, I think all three of us can do that. So that's how we see it.
Awesome. Thank you for that.
Yeah,
right.
I'll hop in here super quickly. I mean, I love what I'm hearing, and it really dovetails to a lot of the same approach we take at Masterworks. I think a lot, what Carter just said is totally right when it comes to the art market. Massive information asymmetry. It's a market that's been around for centuries, that's had very little information or very little innovation at all in terms of its business practices. And certainly in the case of art market data. I mean, art market data continues to be very fragmented. The art data platforms that are out there, the few that exist, are really oriented around the fair value of an object. What we care about is return profile. Nobody else is really building indices to understand What has been the long-term investment trajectory of the asset class? How has it behaved relative to other asset classes? And does that provide the foundation for an interesting strategic investment? So our investment process really has a kind of a top-down element to it and this bottoms-up element. The top-down is our research team that's making and building the fundamental investment case for the asset class. We've published research with Citi, we're publishing research with Goldman and Barings and others who are trying to understand the asset class at a fundamental level. What we then do, understanding the asset class, is then identify what are the specific artist markets that really have the most momentum behind them and how long has that momentum been growing. And so that's when kind of the bottoms up a part of our process really comes in. And that's led by our acquisitions team that's in market with auction houses, with dealers, with collectors directly, really sourcing specific assets. You know, and as Brian said, you know, these are physical objects. We are looking at them. We're doing the title research or provenance research in the case of the art market. We're doing those condition reports, or we're doing the basic blocking and tackling to ensure these objects are what they are when we buy them. Because like with all these guys, the quality of the offering is paramount for us as a business.
Awesome, thank you. Nick, with that said, I'm going to come back to you. Given your experience in the receivables exchange and what these guys just shared, do you have any questions that are in your mind that you would like to see answered today?
Well, I mean, on the subject of, you know, asymmetric information flows as well as fraud, obviously, you know, it's for us with fraud. I mean, I ran when TRE was doing, I don't know how many 100 million a month. I ran, and we broke things up between me and my partner, who were the two co-founders, and I ran the fraud workout division, which was a real eye opener and fascinating. We had hired a bunch of former FBI guys to be our sort of feet on the ground throughout the country, and fraud mitigation is a real thing. And I think for you guys to develop those platforms, you're going to have robust fraud mitigation processes in place to do the work. But that being said, you know, fraud exists everywhere in every single asset class, even the most regulated of markets. I mean, if you look on what's going on, not that it's the most regulated, but if you look on what's going on in the OTC markets right now with the institutions and some of the laws the SEC just passed regarding predatory lending in the OTC markets, I won't get into it here, but it's fascinating. And you know, there's so much money flowing through the system right now that fraud is rampant. So, you know, coming up with fraud mitigation processes is going to be critical to these guys. It sounds like they're all working on their own mechanisms for that. You know, I'd encourage you guys to think about insurance programs where you can wrap an insurance wrapper around their particular asset class in the instance of fraud, for example. There are guys that are willing to do that kind of stuff. And, you know, I don't have a question per se, because everything I'm hearing is all the stuff. I mean, in many ways, it's giving me a flashback of all the stuff that I used to talk about. In fact, in many ways, they seem way more advanced than we were in our first 2-3 years of operations in terms of understanding what they have to do. So nothing I'm going to ask here is going to make them think it through any better.
I think that, you know, what you're bringing up is a really good segue into a very short question on how do you stop the fraud from getting onto your platforms? And short, concise, guys, please. I want to cover a lot more. I have a lot more questions. So,
I mean, in our case, it's through title research and physical inspection. Those are the main, and verification of experience. Those are the three things we do.
Yeah, we're buying only, you know, less than 3% of everything we're looking at. Again, these are physical objects. We're looking at them. We're doing the background research. These are properly documented. We have reps and warranties, you know, with the end seller. And in many cases, when you're buying through auction and gallery, there's reps and warranties with respect to title authenticity and other kind of binary risks that would otherwise be present in the art market. So those are very much top of mind when we're underwriting any of these deals.
Carter?
The dreaded mute button.
Apologies, I'll have to come back to you. I'm having a little
There,
issue.
that's working. There you go.
I'll come back to you in a moment. I'm sorry, I'm having an issue here. Thank you.
Oh, okay. All right. So, all right, we've covered a lot of territory. Now I want to go into which part of people's liquid portfolios should they sell today and put into your platform, into the investments that are on your actual platform. So where should they look to get the money, the liquidity, and to put that into your segment?
I say sell everything in your public market portfolio. Get rid of your bonds and stocks, and get ready for a long period. Nobody knows where it starts, but there's going to be a long period of very low returns. There have been these cycles in public markets before where returns were 2 to 4%, not the 8 to 10% that people are conditioned to. Your reward for earning 8 to 10% in public equity markets, the risk outweighs that. These alternatives have a much better risk reward trade-off. And so I'd just start selling, I would tighten my stops and start, bleeding off some of those growth equities. I'm doing it in my portfolio. My tech stocks are way inflated, and I think it's high time, right? The bond market is telling us something. At least I believe that.
So sell it all.
I gradually sell it all. You don't know where it's going to start, but at some point, these a long period of low returns is in the offing. That is you just don't know when it's going to begin. So I'd start to bleed off of it and get into more alternatives.
All right, Nigel, what's the deal?
We're a long-term asset, so any allocation of your portfolio where you're taking a multi-year capital appreciation type risk, that's where ART is going to fit in. If you have any type of outlook for either a high inflation or certainly a low or negative real rate environment, ART has done extremely well. I mean, I think central banks are going to continue printing money indefinitely, and that's going to really be a tailwind for really anything that's a real asset. So if you already have an allocation to real assets or anything that has that more inflation protected angle to it, ART is a natural risk diversifier within that portfolio.
So give me percentages. Carter, are you back with us, or?
Yeah, I had to reset there. I'm sorry. That's
okay.
I'm back here.
So do you want to take a moment and answer that question?
I love that question. So I'll maybe give you 2 quotes from 2 of my more the obvious favorite investors and popular investors. I think Ray Dalio was out earlier this week. The quote was, "The economics of bond investing are stupid." I could not agree more. Spent too much of my career short selling stuff, and I can't even imagine a world where we have junk right now trading at sub 4%. Just can't imagine what's going on in the bond markets. And I think to Nigel's point, seems like we're going to keep printing money. We're printing a whole lot of it right now, right? So from an inflation protection standpoint, and again, an income standpoint, right? Because Farmland does produce income. That's a pretty obvious source of capital is bonds. The other is gold, right? And I think I'll lean on a Warren Buffett quote, which is, "I'd rather own all the farmland in the United States than all the gold in the entire world." And we also firmly believe that gold is kind of a somewhat silly asset. I've owned it plenty historically myself. I think it's is a hedge asset, but we view farmland as a great hedge asset as well. And again, it's like owning gold, but you also get yield. So that'd be the 2 things I'd yell and scream at. But maybe Brian has it best right now. Sell it all.
Hey, Michael, I'll tell you what I won't be selling. I'm not selling my Bitcoin.
All right.
All
right. So I'm gonna try to put 2 questions into one to finish up here. I want to keep going with you guys, but we have another event that starts in 5 minutes. So with the digitization and NFTs and all the stuff that's happening right now as we speak, in your businesses, which direction do you guys see them heading? And I think I forgot the other question. So why don't you answer that?
Direction for our business is, go ahead.
Go ahead. No, go ahead, Carter.
For us, it's very simple. We have overwhelming demand on the platform. We are absolutely unwilling to give any on the supply side of our business, on our underwriting. And so that's for the future of our business, is investing and doubling down again on making sure that we continue to adhere to very strict underwriting standards on getting, and you know, Brian, this is, I loved your response earlier. I disagree, and I'd love to argue about that another time. I think we have some great conversations in front of us, man. But we, for us, that, you know, adhering to really strict underwriting and transparency, that's where the future of our business is and where we're investing most heavily today.
For us, we are, you know, during COVID, we started offering some shorter term debt products that were formatted differently from our traditional sort of, you know, product to invest in the real estate loans. That showed us that there's a lot of demand across the capital stack and across the risk spectrum, even just within residential real estate. Even if we never moved out of residential real estate, there's a lot of product that we can build with different risk reward trade-offs at different, occupying different parts of the capital stack. And we see a lot of demand in the capital markets for what we do. And so I think, you know, we're going to just keep broadening the spectrum. At some point, we'll probably move outside of residential real estate and expand beyond that. But there's so much for us to do there for the investors and the borrowers alike, or the sponsors alike, that, you know, we'll probably focus on that for the coming, you know, period.
Thank you.
Yeah, for Masterworks, I think what a lot of people don't realize is we're an asset class first play, and not necessarily a distribution play. I mean, the retail self-directed market is where we started. There were a lot of reasons why that makes a lot of sense, and I think will continue to make sense. So, you know, we've raised that $100 million through that self-directed community so far. We by no means feel like we've reached the bottom of the barrel. There's more scale there, but what we're seeing now is some larger investors that are really sharpening their pencils now on what it means to be diversified in real assets, and art's becoming a part of that conversation that it really wasn't even 12 months ago. So that's going to open up some opportunities, both from kind of investor type standpoint and eventually distribution channel standpoint. And so finding product market fit within some of those opportunities is a big focus for us here in 2021.
Nick Perkin, any closing comments?
Yeah, I mean, I think the only closing comment I'd make is that, as I think some people touched on a little bit earlier, which is, look, you've got the Fed coming out and saying no change through, not by, but through 2023. And you've got what seems like endless stimulus. I mean, there's no way this is the last of the stimulus. Because if you ever indicated that, the wheels come off. So you're going to have an environment now where asset prices are going to increase. I mean, I could be totally wrong, but I just don't see how asset prices don't increase. Now, your purchasing power is going down. So your ability, your real dollar purchasing power is decreasing, absolutely. So a lot of these asset classes make a lot of sense. I mean, to diversify into these asset classes that are going to maintain value relative to purchasing power. Gold gets to serve that purpose, but now you can not just diversify into gold, but you can diversify into all these other asset classes and be diversified within your diversification. So it's a very interesting time.
Thank you all for your time today. I could sit here and grill you guys all day long, and you know, get to connect with my friend Nick, who's looking good. He's in top shape. But I want to leave my last.
It's a home prison workout, Corcelli.
I want to leave my last comments today. I hope that you guys stay true to your knitting, and I hope on the diligent side, and I also hope that you keep continuing to serve people who are not able to get access to these types of investments, these types of asset classes. I really love what you're doing, and I hope that you don't, you know, bend in any way so that you can serve the community that we represent at FLAIA, which is a very institutional community, which some of them are probably going to be mad that I said that to them today. But thank you guys. I appreciate you for taking your time today.
Having us.
Great. Well,
Really appreciate the time. Thanks.
All right. Thank you guys.
Thanks, guys.
With that, I am going to move